and welcome to Trading Hour. I'm Ritu Singh, and joining me live from the CNBC-TV18 Motilal Oswal studio in Mumbai are Mangalam Malu and Hormaz Patakia. Look at the markets. It's been a volatile day of trade. Started up and now down about 128 points on the Sensex, 43 points on the Nifty as we speak. The mid-cap index also down about 215 points. The bank Nifty has also taken a knock, down about 120 points as we speak. Market breadth very much in the favor of declines, the ratio being at 1:1.8 as we speak at the moment. All the major indices are in the red, barring exceptions like the FMCG pack. You have the energy, metal, IT and PSU bank index. But, lots of focus on individual stocks. Mangalam, Hormaz, hello, take it away.
Yep, indeed. A lot of focus on individual stocks. Today, though, it's the highs were sold into. Let's see whether the lows get protected or not. The advanced decline as well. At this point of trade, firmly in favor of decliners, just like yesterday, where over 2,000 stocks declined. Right now, we have about 1,800 stocks in the red. But if one had to clutch onto straws, the Nifty is still holding on to the 50-day moving average. And a lot of these PSU banks are doing fairly well. The rupee itself has strengthened back from record lows. So let's see whether this is just temporary or this is something that continues going forward. So those are a couple of indices, stocks and macros, which are slightly better than what we saw yesterday. But a lot of stocks which are buzzing. Hormaz has walked across to the wall.
Well, the broader market's not painting a pretty picture, but there are certain names that are doing fairly okay for themselves in today's session, even in a market like this. And Apex Frozen Foods is one such name. Now, the stock has done well in the recent past. It's gained in 4 out of the last 5 sessions. It's up 9% today as well. It snapped an 11-day losing streak last week and then has managed to rebound from those lower levels. Today's session, we have seen over 10 lakh shares traded, the 20-day average of 5 lakh shares, so already double of its 20-day average. It's been constantly taking support at its 50-day moving average, which is at 260, and it continues to rebound from those levels. And as a result of this gain today, the stock has turned positive on a year-to-date basis. The stock was up around 20% last year as well. Polycab is a stock that's not doing well for itself today. At the lowest point of the day now, 4% lower, among the top losers on the Nifty 500. It snapped a 4-day gaining streak today. The volumes, the stock has declined on volumes that are the highest in 2 months, and the stock has already seen over 15 lakh shares traded today. The 20-day average is just 55,000 shares. The stock has also now broken below its 100-day moving average, which is over 7,300. And after 8 straight months of gains, the stock is now seeing its 2nd straight month of losses. And at this pace, this could well turn out to be the first negative year that Polycab has had after its listing. But one stock that continues to buck the trend is EPAC Durables. The stock was the top gainer in the broader markets yesterday. It's extending those gains another 9% higher now after yesterday's 16% surge. Today's volumes are already well over 50% of Tuesday's volumes, and the turnover already is at more than 65% of its free float market cap. Now, over 2 crore shares have already been traded on EPAC Durables. The 20-day average is just 1.5 lakh, and the stock has now convincingly moved above its 50-day moving average of 299 and is now up over 30% from its 52-week lows of 245 that it had fallen to last week.
Take that point, Hormaz. Thanks a lot for that. So those are a bunch of stocks which are buzzing, none harder and bigger than Meesho, up around 8.5–9% right now, moving towards the 200 rupee mark. And that's after, seeing a stellar listing and those gains post-listing sustaining as well. In fact, now as we speak, Meesho is up 17%, 211. So last time I checked, was up around 10%, and it's seeing gains in quick succession. Remember, a large part of the equity is still blocked for trade, so it is moves which are happening on low float which is available in the market. But today's up move can be attributed to the UBS note that has come by. They've initiated coverage on the stock with a buy rating, target price of 220, very close to where we are right now. It implied 22% upside in the morning, but now it's about 5–10% upside itself after a 17% move that we've seen. Asset light, negative working capital business, ensures that there is positive cash flow. That's something that Vedanta told us as well. They have over 1,000 crores of free cash flow, and they believe that this will grow. The net merchandise value for them likely to compound over 30% over the next few years because of the headroom that is available. And all of this comes at an improved contribution margin. Global benchmarks are between 8 to 10%. The company did about 3.8% in the first half of the year. The management said that they would like to veer towards the global benchmarks, and right now the expectation from UBS is 6.8%. The average order value has declined, and that's by design because the company has been passing on efficiencies to the customers, and that has resulted in increased order frequency. So order frequency has increased from 9 to 15, and they believe that average transacting users, which are about 1 in 6 Indians right now at 20 crore, that itself will surge to about 51.8 crores over the next 3 to 5 years. And as a result of which, they believe in the long-term story of Meesho, the stock gaining in short term already. But another stock which is on our radar, late towards trade end yesterday, we got the update on Vedanta, where the NCLT has approved the demerger, and Kotak Institutional Equities has written on the stock today.
Well, that's right. Kotak Institutional Equities, they have gone ahead and they have upgraded Vedanta to buy with a target price of around 650 rupees. They have revised the consolidated EBITDA by around 4 to around 6% because they are factoring in higher LME prices and weaker Indian rupee as well. Now, it's important to note that commodity price assumptions that they are working with are 5 to 25% below the spot rate. And they are saying that their FY28 EBITDA actually would be 10% higher on spot prices itself. And so their bull case pegs the target price at around 770 rupees. That's on FY28 assumptions. A few factors that they've noted, they're saying that buoyant commodity prices, well, that's putting Vedanta in a good spot. On the aluminium division, which is bulk of their profitability, they're saying that one as well is in a very sweet spot with growth as well as margin accretion drivers going ahead. And because of that, on the aluminium business, they're estimating, EBITDA number of close to around 1,077 or 1,100 and then 1,200 over the next few years. That compares, remember, with around $940 on a per ton basis. So they're clearly expecting the aluminium margin to move up substantially. And finally, the last point that they make is the parent, Vedanta Resources' debt concerns are now well behind. So all in all, Kotak quite impressed, with this NCLT green signal with regard to the demerger, and they have gone ahead and upgraded Vedanta Limited.
Second upgrade in the last 2 months as well. Nigel, thank you for that. The upgrade coming in on Vedanta. Of course, the stock at record high levels. 580 was the high that it made earlier in the day today, and still trading with gains of around 0.75%. Take a short break. On the other side, everything bond markets with Manisha Gupta.
Presents Bond Street.
Well, as promised, let's shift focus to India bond market, and I want to refer to the latest Niti Aayog report, which talks about on how India corporate bond market really needs to grow 7 times at current size. That is, if it wants to meet its long-term or bring it long-term financing demands. If it also needs to do that, if it wants to reduce its heavy reliance on bank-led debt, which is currently the market in its current shape and form there. Also, when you look at the US bond markets, well, they are larger than their equity markets, and that clearly is a phase that we have seen with most of the developed world. When you look at the India corporate bond market, well, it stands at around $650 billion, which is much lower, versus UK, which has a bond market of around $4 trillion. So that really is the case with US and China as well. Huge bond markets, large scale as well, and you have a big participation continuing there, which is not the case for India right now. The other thing that the Niti Aayog report puts out is that when you look at the India's equity market, globally competitive, but the corporate bond market is 1/7 of its size, and this is what the Indian financial markets perhaps needs to work on. And having said that, it is only 1/6 of the corporate debt market in India, which is raised via bonds. So while of course you have to work on the overall bond market in India, but it is the corporate bonds which really need to be in focus right now. The other thing that the Niti Aayog report puts out is the bond issuance timing in India, which is quite slow at around 20 to 60 days. This is vis-a-vis 1 to 5 days that it takes in US and UK to issue a bond there. The push to the India bond market also comes in on the fact that the regulatory coordination needs to be worked upon. The only way that you can push the bond markets in India is by the way of improving infrastructure, by broader issuer participation as well. The other thing it talks about is the introduction of newer instruments which comes in case of green bonds, energy transition bonds, rural development bonds, and MSME-focused securities as well. Technology-driven platforms also, while we do understand that the online bond platforms, there are 29 of them right now. But this is yet another thing that would perhaps drive the new model success that equity markets have seen to be replicated in bonds as well, to ensure that we see stronger numbers there. Well, that's about the bond markets. But with that, let's slip into a short break. When we return, we'll discuss markets and stock prospects.
CNBC-TV18 and India Bonds presents Bond Street.
Still fighting to hold the 50-day moving average on the downside is the index, around 20 points lower. So we're still off the lows of the day, ever so slightly, but we are off nonetheless. A couple of movers in the broader markets. Look at Apex Frozen Foods. We spoke about that, 11% higher on the stock. And Walchand Nagar too. We spoke about this earlier in the week. The stock is up 12% in today's session as well. But Mangalam has hopped over to the FNO desk and he's telling us what are the latest trends in this midweek trading session. Mangalam.
Well, down but not out. That's exactly what, the mood of the market is right now. The Nifty is just about 18 points in the red, which is a recovery from the lows. At the same time, while it's off highs, nothing really to worry about because it's holding on to important levels. If you look at, the advanced decline ratio as well, there are more stocks declining than the number of stocks which are advancing. But from 15 minutes ago, where there were just 800 stocks in the green, now that number has moved into triple digits. So it's about 1,000 stocks, or rather, triple zeros. It's about over 1,000 stocks in the green right now. Those lines coming slightly closer. A bunch of stocks which are buzzing with a fair amount of volumes backing them as well. You have AB Fashion and Retail, you have IGL, you have M&M Financials. All of them have some volumes backing them. And alongside that, we've seen some traction on SBI, Can Bank and Bank of India. A lot of these PSU banks too. Maybe the strength in the rupee has something to do with these PSU banks being well bid in today's trading session so far. The Nifty is held on to important levels. We spoke about the 50-day moving average, 25,789. Now, the next thing to watch out for is whether the Nifty bank goes ahead and crosses past the 20-day moving average of 59,300. If that happens, then the recovery is well and truly underway. But, both call writers and put writers believe that the market right now is in this very narrow range. The 25,900 call writers, which corresponds with today's high, they are still fairly active in today's trading session. The premium down 28 rupees, about 100 rupees in premium, telling you 26,000 still remains an extremely important resistance. Stiff resistance between 26,000 to 26,050, notwithstanding the recovery that we've seen. But the fact that there has been recovery tells you that 25,800 is an important support as well. So the 25,800 put fairly well bid as well. And that stock, that option is trading at around 90 rupees, telling you between 25,750 to 25,700 is important support. So broad range on the index, 25,750 to 26,050 on the whole. A lot of individual stocks on our radar. We have Hind Zinc, which has seen a lot of long build-up, even as silver prices have moved higher. So that stock has moved to a record high. And interestingly, a lot of shorting activity on Polycab. So we don't know any news out there, but typically, Polycab, the stock moves happen before any sort of news comes by. A big spike in open interest. The stock is down 4%, and that open interest spike, understandably, is on the short side. So maybe we'll monitor if there is any news that comes by on Polycab. With that, we'll take a short break, come back on the other side.
Yep. Just before we do that, Abhijit Choksi from Stossify is with us for a quick chart check. Abhijit, good morning. Thank you for joining in. We are stuck in this very narrow range, right, between the 50 DMA and the 20 DMA. Are there any signs on the charts of a breakout in either direction, say above the 20 DMA or below the 50 DMA? Your call on the index and your specific stock recommendations as well.
Yeah, hi, good morning. So in stock specific section, I like this MNC power company called GE Vernova. It's the part of the global energy group GE. Now, the crazy part about this company is that 50% of India's power is monitored through the solutions provided by them. NTPC, Adani, Transmission, Reliance are their main clients. And what I like about this is that in just 1 year, their EBITDA margins have doubled and the company is almost debt free with 35% consistent 5-year CAGR growth. I'm just seeing this as a bet where a company responsible for 50% of India's power grid is available for less than $10 billion. I believe this is more like a safe stock in such kind of a market environment where this story seems like a good compounder. Thank you.
Well, Abhijit, quickly on, Shriram Finance, given the expectations of deal announcements after their board meeting this Friday, and On the larger banking NBFC pack, with the kind of FDI flows we've seen come in this year, any top picks?
Yeah, I'm liking JM Financials in that sector. I believe that is more like a safe recommendation. There's just a disclaimer that I have already recommended to my clients at stockify.in. Thanks.
All right, Abhijit, we'll leave it at that. Thanks very much for joining in with your recommendations. On that note, we'll take a very short break. Don't go anywhere. We're back with the markets in just a bit. Welcome back. The Lok Sabha has approved the Insurance Amendment Bill, and this allows foreign companies to own up to 100% of Indian insurance businesses. The government believes this is going to bring more money into the sector and make it stronger. The bill has also introduced changes to improve how insurance companies are run and to increase insurance coverage across the country. We spoke to a whole host of industry experts. Listen in to what they made of some of these changes.
We have been making our position clear on open architecture. More than the insurance companies per se, yes, insurance companies also had its own benefits to look at, but looking at how the customer should be served, it is difficult for an individual to be knowing the products, multiple products of many life insurance companies and going and presenting the right product to the customer. It was not going to be an easy task. An agent representing one life insurance company would have been beneficial for the agent as well as the end consumer as well. We were requesting the government for making this provision available, and I'm sure the government had taken a stand, and open architecture, which was originally proposed or it was being talked about, is not part of the current bill. Certainly LIC stands to gain the sense, as you said.
The fact that we weren't necessarily entirely comfortable on multi-tied agency, given the fact the amount of money that is spent on an agent can vary between 15 to 25,000 rupees that a company spends on training an agent over 3 to 5 years. So that was a little bit of a tricky one, and I'm happy to see that it doesn't find the light of day here. The investment guidelines have been made a lot easier, is very good. I'm particularly excited about the fact that we can now invest in private limited companies, which usually are the companies who have invested in technology and can get early investment, and not just do they gain, but even we gain at the same time.
In fact, Tarun Chugh also confirmed the CNBC-TV18 news break from the 15th of December on the life insurance industry moving towards deferred commission model for distributors. The Bajaj Life MD and CEO also said that moving towards this deferred commission model will certainly be a welcome move.
If there is regulation where kind of it is mandated that they're more deferred than upfronted, it will be lesser of an eyesore, is the way I see it. I welcome the fact that there is a overall commission discussion that is going to restart, and the chance of it being deferred should be welcomed as well. Let's see how the transitioning happens. The issue is always in the first year transitioning, and I think people have their own business models. You have to see how the IRDA helps the industry or handholds the industry in this regard.
All right, that is about the insurance space. The market is giving up some of those gains that we saw just 20 minutes ago. So the Nifty now down about 40 points, with coming very close to moving into the green, now down being about 40 points, moving towards that 25,800 mark. It'll be very interesting to see that if the market finds support once again here, because if that happens, there'll be a double bottom for the day, and thereafter we would see a bit of an up move from here. In case it breaks that, then there could be a bit of a rough ride as we move towards the end of trade. Asian Paints, Apollo Hospitals, both of them currently at the low point of trade, and even as banks are doing well, a couple of these NBFCs not particularly well. So Bajaj Finserv is one which is lower as well. Before we take that break, just pull up the intraday chart of Eternal too. That stock's been under a fair bit of pressure over the last few trading sessions. Today opened in the green. There was a positive brokerage note that came by as well. But now, quickly, the stock's given up all those gains, sitting with a gain of just about 75 paise. Take a short break, come back. Market fundamentals with Prabhakar Kudwa of Samviti Capital.
Welcome back. You're watching Trading Hour. The market's still in the red. The Nifty tried a bit of a recovery we've been seeing, but in the last hour, but still holding on to about 25,800 levels. The Sensex still down about 149 points as we speak. But Prabhakar Kudwa from Samviti Capital joins us now to discuss some market fundamentals and his top sectoral picks. Prabhakar, welcome. Thanks for being here. In the current volatility that we're seeing, what are some of your top sectoral picks for the next 6 months or so, and why, if you could take us through that?
Yeah, thanks for having me. I think what's really doing well, especially post the GST cuts, has been the auto ancillary space. I think autos and auto ancillaries in general are doing well, but auto ancillaries specifically because they seem to be, have reached a sweet spot where both the domestic as well as the export markets are doing well for them. And a lot of premiumization is happening in the Indian automotive space. And a lot of these auto ancillaries are seeing not only a top line growth, but also a margin expansion. So I would say auto ancillaries remains one of the best spaces over the next 6 months. Other than that, I think the power space, right, which actually did very well in the last cycle, also continues to do well because it has, again, multiple tailwinds, both from the domestic T&D, that is transmission and distribution, as well as the whole AI capex, that's happening, and where these are the ancillary beneficiaries. So power remains the a sector where there is good earnings visibility at least over the next couple of years. And third, I would say is the pharma space where there is a tailwind driven by GLP and a lot of other peptides. So a lot of Indian companies that are in that space are likely to do very well over the next 2 to 3 months. And finally, I think selected mid-cap IT names, which again, are enabling a lot of IT for enterprises, seem to be in a sweet spot.
Alongside that, some of the select pharmaceutical names as well. Right, Prabhakar, I just wanted to know about IGL because while you like power, a couple of these utilities are doing fairly well as well. IGL is up 7% right now as we speak. The street believes that this one nation, rule that has come in for city gas distributors should be beneficial for customers, and as a result of which, increased volumes for a lot of these city gas players. Do you put them in the same bracket as some of the power players in terms of utility?
Not really, Mangalam. I think the regulated utility players, right, they have capped ROEs. So I think they are more of a play where you buy them when they are undervalued, and you have to kind of sell them when they get overvalued. The segment that I'm talking about primarily is the segment that's focused on the transmission and distribution space domestically and spaces where they are exporting stuff which is enabling the AI capex globally.
Prabhakar, pretty much large consensus on the street has been on private financials. Does that not feature in your pecking order because of the large-scale foreign investor interest that you are witnessing, particularly in the mid-sized financials? You saw some deals in Federal Bank, RBL Bank, Yes Bank, and now you are watching a new large name, Shriram Finance, entering the fray as a board meeting on Friday. Why not private financials in your pecking order?
Yeah, I think the primary reason is that if you look at a lot of these financials, right, the size of a lot of these, at least the large cap financials, has become, the base has become quite big. So the growth rates that an HDFC Bank and a Bajaj Finance used to show in the past, right now they have halved. So I think there is not so much, for a growth investor like me, there is not so much of opportunity there in that space because the valuations are fair, the growth rates have slowed down, and the larger names are more likely to mimic what broadly the GDP or 1.5 times the GDP growth, right? So we're talking about anywhere between 10 to 12 or 14% growth, right? So in the larger names, that is why I have not featured them. The mid cap names, to be honest, while the prices have done well, right? If you go back and look at the numbers, right, the earnings are nothing that exciting, right? The earnings, because the credit growth itself has been quite anemic over the last couple of years in India. So since I don't see the numbers yet, I'm not very confident to go and bet on them.
All right, Prabhakar, apart from, some of these names that you mentioned for the broader markets, cues in terms of what's happening on the macro front with the rupee, any select names there, and, domestically, some of the cues to look forward to before we close the year.
Yeah, I think like I named a few. I think mid-cap IT is a very good way to play, the rupee, right? Because again, what I mentioned for the private financials holds good for the big 3 or 4 IT names, right? The growth rates have been anemic, and there are not much of tailwinds for them. The size is too big, so even if they have a piece of the AI, right, it will not move the needle, for the entire revenue pie. So I think mid-cap IT names, which are focused on the AI enablement for enterprises. And I think a lot of names which have kind of been beaten down because of the whole tariff thing, right? I think it's a matter of time that this tariff issue gets resolved. It's been delayed already. So I think a couple of some textiles, I think can be an area where there can be a 6-month trade. Similarly, a few shrimp players, right, who have done quite well in spite of the tariffs, right, can be an opportunity over the next 6 to 12 months.
Just pull up Meesho, 20% circuit now on the stock, and it's now nearly doubled from its IPO price of 111. And in line with Meesho, also pull up Urban Company. That stock has seen a very sharp spike. That has also moved towards the highest point of the day now, 4.5% higher there as well. And that is rebounding from the post-listing lows of 120 that it had made. Any of these new listings on your radar, Prabhakar? Meesho, Lenskart, Urban Company, all of them have come with a lot of hype. Urban Company from 200 is down to 120 now, but Meesho continues to move higher. Anything that you have spotted?
I think a lot of us put all of these new age companies into one bucket. I think it's important to differentiate between them. A lot of us get carried away by the success of Zomato, which is eternal now, and Paytm, right? But we have to really understand that Zomato and Paytm were basically had the sector itself had very less competitive intensity. There were only 3 or 4 players in the entire space. But if we talk about the electric two-wheelers or any of these other spaces, right, although they are new age platform companies, the competitive intensity is very high, right? So unless you have a space where there are only 1 or 2 players who are dominating, who have network effects, I think we'll have to be really selective in this new age space. And a lot of them are being dressed up for the IPO, which is very clear from the numbers, right? There's good revenue growth, but the profitability has only improved over the last 1 year or the last few quarters. So I think one needs to be very selective and bet into the new age spaces wherever there is some sort of a competitive advantage.
Right. From the conversation that we've had so far, the sense one gets is that you veer more towards value and, companies at a price rather than paying absurd valuations for promised growth. In that case, you like the financials. Where do the public sector banks stand in your overall scheme of things? Today, they're fairly well bid. You have SBI, which is among the top gainers today. PNB is doing well. We have Bank of Baroda. So do you make that distinction as well, basis the valuations at which they are available?
Mangalam, I think the first criteria for me always has been growth. I think you have to look at value relative to the growth, right? So in a lot of these names, there is no growth really to speak of, which is why I said even the large private financiers I'm staying away from, is because the growth is not, the superlative growth or an above average growth is not there. So I think the number one criteria has to be growth. Once you have growth, then you look at valuations as the second criteria. So I think in these names, in the absence of growth kind of keeps me away. And in the new age companies, while the growth is there, when you come to the second factor, right, the valuations are absurd and the profitability is just not there. So I think that is what kind of keeps me away from them.
All right, Prabhakar, thank you so much for sparing time and joining us today with your views on the sectors and specific stocks as well. Take a short break. Our big story on the other side. Stay tuned. Welcome back. Continuing to meander in that very narrow range is the index, but the big story of the day is the record foreign inflows into India's financial sector. While overall foreign flows are ebbing, the financial sector has seen inflows of over $7 billion this year. And another big one could be on the cards, with Shriram Finance set to consider a fundraise on Friday. A development that comes after reports suggested that Japan's MUFG is set to pick up stake in the company. Gaurav is first here with more on the Shriram Finance details. Gaurav.
Well, yes. So much awaited, or rather I should say much speculated deal is likely to happen, because on 19th of December, which is Friday, Shriram Finance is going to have a meeting where they will consider fundraising, which also includes QIP. Now, why this is important is that earlier we have seen many speculations happening around Shriram Finance that MUFG, the Japanese firm, is looking to buy around 20% stake in the company. In fact, the latest reports suggest that the valuation is going to be anywhere around $3.2 billion for the company for 20% stake. Now, why this is important for Shriram Finance? If you look at Shriram Finance, they already have around 20% capital adequacy ratio, which is more than enough of what is required at 15%. So this fresh capital, this can be used to reduce the cost of fund. That is number one. Second is that we have already seen management actually being a bit bullish about their growth guidance. They say that the growth could be somewhere around 17%. And at the same time, given this scenario, another rate cut is also happening, and at this moment, this can also lead to reduced cost of fund. Now, given that MUFG, if it enters in Shriram Finance, this will also make a case and headroom for further credit re-rating, and that is the reason why we may see further cost of fund decreasing. So, all in all, it is going to be positive for Shriram Finance. Now, if you look at the stock performance in the last 6 months, already we have seen the stock was up almost by 27%, and another headroom which to highlight is that if you look at valuation now, price to book for FY27 earning, it stands at around 2.2 times for Shriram Finance. If you compare it with its closest peer, which is Cholamandalam Investment, it trades at around 4.1 times. So definitely there also makes a case that there is a headroom for growth even further. So given that all these developments are happening and this is the end of the year, we are hoping to see some big move, specifically in terms of the news flow. And on back of that, we will definitely watch out on the announcements coming up from Shriram Finance on this Friday.
All right. Thanks a lot for that. All these announcements coming by on this Friday, Ritu. But foreign investment, how has that picked up in India's financial sector? You've done a deep dive.
Well, Mangalam, this Shriram deal is only going to be a cherry on top of the cake. It's been a spectacular year. Record foreign capital coming into banks and NBFCs in 2025. In fact, so far, we've seen about $7.5 billion already come into banks and NBFCs. The largest one, of course, coming from Emirates NBD, which acquired a 60% stake in RBL Bank for nearly 26,850 crore rupees. That's about $3 billion. And the story will get even bigger if this reported Shriram Finance MUFG deal does go through. And it's going to surpass all records, estimated at what Gaurav was telling us, $3.2 billion. And that will push the total foreign capital that has come in this year alone into banks and NBFCs at $10.7 billion or more. But it's more than just these numbers. The RBL Emirates deal and the Samman Capital IHC investments, that marks a shift from minority stakes to more operational control that we're starting to see. In the secondary market transactions as well, we're seeing ownership getting reshaped. For instance, in Yes Bank, SMBC, the Japanese lender, is going to be the largest shareholder, largest foreign shareholder at 24.2%, although not categorized as a promoter. Private equity sovereign funds, they're also making some long-term strategic bets with what we saw with IDFC First Bank, and also Federal Bank and Blackstone earlier. The investor mix is also quite diverse when you look at these foreign players. So global banks like SMBC and Emirates NBD BD, sovereign and holding companies like ISC and ADIA, and private equity like Blackstone and Warburg Pincus. What is striking is also the shift from minority stake to capital infused growth. So unlike previous years, the deals this year are quite large, they're strategic and often promoter changing as well. So the sector itself is maturing as a global investment destination, and that seems to be supported by RBI's evolving stance on allowing foreign ownership in Indian banks. A quick look at the headline deals. The largest one, of course, RBL Emirates for 26,850 crores. Yes Bank SMBC up next, 16,330 crores. Sammaan Capital IHC 8,850 crores. IDFC Warburg and ADIA about 7,500 crores. And Federal Bank Blackstone at 6,169. Altogether, that alone is worth more than 65,700 crores flowing into Indian banks and NBFCs. A clear sign of some strong global interest in the sector. And now we're awaiting more, because we're not done just yet.
Oh yes, we'll all be watching out for Friday when Shriram Finance holds its board meeting for that fundraise. But Ritu and Gaurav, thank you for summarizing our big story for the day. Take your leave on this edition of A Trading Hour. Mangalam, Ritu and I say goodbye. Halftime report on the other side.